Welcome to the Fear and Greed Daily Interview. I'm Jennifer Duke. We're now halfway through earnings season and are getting a clearer picture of the trends and some of the factors affecting companies reporting their results. Last week saw some big companies reporting with some mixed outcomes, and this week's also gearing up to be a bit of a busy one. It's a lot for investors to process. That's why we thought we'd invite Roger Montgomery, the founder and chief investment officer of Montgomery Investment Management, to take us through some of the stocks and trends that he's watching. Now, this information is general in nature, and you should seek professional advice before making any investment decisions. Roger, welcome back to Fear and Greed.
Great to be with you, Jen. Thank you for having me.
So let's have a look at some of the companies that you've been keeping an eye on. What did you make of car sales last week?
What was interesting is that despite us absolutely soaring fuel costs, which were expected to, really hit sales of SUVs, which are obviously the biggest selling vehicles in Australia, that didn't seem to happen, which was interesting. I mean, the company did report a 301% increase in full-year profit, but you have to remember that was boosted by a revaluation of about almost $500 million, about $486 million of its minority stake in a US-based website called Trader Interactive, and also a Brazilian business that it owns called Web Motors. So on a pro forma basis, which is where you're assuming consolidation of the acquisitions in both periods, the revenue was up about 18%. It's still a good result and was somewhat surprising.
So also Nick Scali reported last week. Any thoughts on their results?
Yeah, so Nick Scali was interesting because, number one, it came out with earlier in the year, around May, the company had been saying that things are looking pretty bleak, and the share price consequently was hammered. But they have completely outperformed expectations. They reported sales revenue of about $508 million. That was up 57%.
That's crazy.
Yeah, and a gross margin of 63.5%. Now, part of the reason for that is that they've seen what they've not done is discounted their products, but they've seen lower freight costs, and that means their margin has gone up. And that's continuing into the new year. So what's happening is shipping expenses have declined since March, but they're selling their product at the same price. Rather than pass on the lower shipping costs by lowering prices, they're maintaining their higher prices, and that means they've got this terrific margin improvement. And so they've got better buying conditions because their buying power is improving. And if analysts start to see this as structural, then analysts are going to upgrade their earnings estimates for next year, 2025 and 2026 as well.
So those two didn't do what I expected them to do at all, given the cost of living pressures. But what about JB Hi-Fi?
Yeah, JB Hi-Fi is a slightly different picture. I mean, they still are a brilliant business. They are really the sort of the litmus test for consumer, sort of a consumer picture, notwithstanding that new CBA household spending insights report that's now being conducted on the 7 million credit card and debit card holders that the bank has, will be pretty useful monthly report, I think, because that'll be up to date. Notwithstanding that, JB Hi-Fi is the litmus test for consumers in Australia, and they had sort of mixed results. Their sales increased by just under 6%, which was great. Same-store sales was up about 5%, but the Good Guys, their results were only up 0.8%, and their same-store sales growth was also up 0.8%. What's interesting is that the Good Guys, which obviously are selling major appliances, they're at the tail end, or they're selling products that are largely at the tail end of renovation demand. So people, I don't know if you know this, Jen, but people buy houses or they buy an apartment, and typically, in aggregate or on average, there's a 10-month lag between buying a place and then renovating a place. And that's because, it takes time to apply to council and so on. And then after the renovation's done, then you see demand for appliances, fridges, freezers, those sorts of things, people installing those into their kitchens and so forth. And that is starting to slow down a little bit. So JB Hi-Fi noted that there's increased variability now across months and across sectors, and that's going to make it challenging for them to optimize their inventory. We saw their inventory come off about 8%, which says that they're pretty dynamic managers of their inventory. But how they manage that going forward is going to be quite a challenge, because like-for-like sales have definitely slowed down.
Stay with me, Roger. We'll be back in a minute. My guest this morning is Roger Montgomery, founder and chief investment officer of Montgomery Investment Management. That housing factor is fascinating to me, actually. And I did think we also saw Domain's results, and REA was a couple of weeks ago now. What do you make of those two in light of that picture with listings and what they were posting?
REA is a phenomenal business, and we've owned it in the past. We've talked about it for the last 13 years on our blog, and it's one of those businesses that you can count on. You can count on two hands the businesses of the highest quality in Australia that have sustained that high quality for a very long time, and REA is one of them. What many people don't understand is that REA's performance is not tied to house prices, but it's tied to listings. And what's interesting is that over the last decade, national listings have actually been declining in Australia, and yet REA's profit and revenue have been rising most years, with the exception of the COVID, of course. But the reason for the rise in revenue has been within them, they harbour the most valuable competitive advantage of all, and that is the ability to raise prices without a detrimental impact on volume. And the worst thing you can do is if you start a business, you start generating really high rates of return on equity of 30 or 40%, your worry will always be that a competitor comes in and charges a lower price for the same thing.
Yes.
And they'll undermine your profitability. Well, the worst thing a competitor could do is offer the same product for free. And here's the thing, there are 83 websites in Australia offering people the ability to list their house for sale. And of those 83, about 78 of them or 79 of them charge nothing for it. And yet REA's website, realestate.com.au, has the most number of houses and the most number of viewers, despite the fact it's the most expensive. So you really want to own a business that can raise prices without detrimentally impacting unit sales volume. And they've been doing that regularly, and they're going to do it again in a couple of months and raise their prices quite a bit by double digits. And they won't see any reduction in the number of people wanting to sell their house. In fact, when it gets tougher to sell, it's more important to have your property listed on REA so that you can sell your property. And then, of course, they're going to get a massive boost because listings have recently increased. Now, whether that's sustained or not, we don't know, but listings are picking up because there is some pressure on people to sell property as a result of the 12 interest rate increases that the RBA has put through.
Now, we will get to what's happening this week in a moment, but I can't help but ask you about a blog that you had up about the mortgage cliff and how it's more of a stepping stone. Can you explain why you don't think we've got a mortgage cliff, and what's a stepping stone, Roger?
Yeah, well, I write, many people would know that I write a fortnightly column in The Australian, and back in November last year and earlier this year in March, I think it was, I wrote a couple of articles for the Oz just explaining that all of this fear-mongering about the mortgage cliff was misplaced. And the reason everyone was concerned was because there's a very large number of people who'd borrowed money during the period of the term funding facility that was offered by the Reserve Bank of Australia to the banks. And that meant that the banks could borrow for 3 years at 0.1%. And consequently, when they can borrow money really cheaply, they then go and lend that money really cheaply. And so they were offering 3 and 4 year mortgages for as little as 1.98%. And so a lot of people borrowed money fixed rather than variable. So in Australia, we usually see people on a month-to-month basis. It's usually sort of 15 to 18% of new mortgages written that are fixed, and the rest of them, the vast majority, 82% or thereabouts, are written variable. But during 2021, there were a couple of months there where about 45% of new loans written were fixed. And that's because the fixed rate was lower than the variable rate at the time. And that's highly unusual. We don't see that in Australia, and that's why we saw that jump. But remember, I remember years and years ago, Jen, and I'll just digress for a second. I remember reading, I was at university, and I remember reading a newspaper headline, and it said, what did it say exactly? It was something like 40% of homes burgled have inadequate security. And that was the headline. And I thought to myself, and I was studying statistics at university at the time, I thought, well, that means 60% of homes burgled have adequate security. In fact, you're better off having no security because there's only a 40% chance of you being robbed.
Don't let logic get in the way of a good headline.
No, that's right. And so it was the same thing that I noticed with all of these headlines about the mortgage cliff. They're saying 45% of people on a monthly basis are taking out fixed rate mortgages. They're going to roll off onto variable. And when they roll off onto variable, they're going to go from 1.98% to 6%. And, they're going to have to sell their houses. They're not going to be able to afford it. And I thought to myself, but hang on a sec. Even at those peak months when 45% of loans were written as fixed, 55% were written as variable. And even before that, we had 85%. The standard is about 85% variable. So the vast majority of loans, like a significant number of loans, are variable, and they've already experienced the increase in interest rates, and we're not falling off a cliff. So this smaller proportion of people who are going to go from fixed to variable, yes, there'll be a few people that are shocked by it, but we already know the vast majority have been able to stomach, endure and survive the increase in interest rates without pushing the economy into a deep recession. So these few people who are going to switch from fixed to variable, they're not going to be the straw that breaks the camel's back, so to speak. So I was just saying that everyone's unnecessarily concerned about this. It won't be a cliff. It'll be a gutter that we'll step over. It will be a speed bump, not a cliff that will all fall off.
I don't think I can argue with that logic. And just finally, what should investors be keeping an eye on for the week ahead?
Well, we're still in the thick of reporting season, so it's going to be a busy week. And again, I think everyone will be thinking very, very carefully about the businesses that sell to retail. So Universal Store, for example, will be reporting next week. And these are some of the smaller cap companies, because I think that's where the interesting stories really are. Obviously, the headlines are dominated by the majors, but really what we want to know is what's going on in consumer land, because it's the biggest part of our economy. So Kogan will be out. Domino's Pizza will be out. Breville will report. Breville's an interesting business, just as an aside, because a lot of people think of it as a retail business. They don't have any stores. They sell through other stores. They are a brand ambassador, if you like, and an inventor. So we really like that business. That'll be an interesting one as well. Ardent Leisure will come out, so we'll see how spending on recreation is going. So, there are some interesting retail businesses that will be putting out their results, and all eyes will be on them.
Roger, thank you very much for talking to Fear and Greed.
Great to be on the program again. Look forward to talking with you again soon.
And that was Roger Montgomery, the founder and chief investment officer of Montgomery Investment Management. This is the Fear and Greed Daily Interview. Remember, this information is general in nature and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Jennifer Duke, economics correspondent for Capital Brief and filling in for Sean Elmer. Have a great day.